Okay, hello everyone, this is Mapletree Pan Asia Commercial Trust, 4th quarter and FY 23-24 financial results, dated 24th April 2024. We'll look at the key highlights. Right, 4th quarter FY 23-24, DPU is up 1.8%, right, so we are very happy to see this, right. This is a reversal over, I believe at least the last 2 quarters were negative and quite badly negative DPU drops. Alright, so the first change, right, so we have an upswing with 1.8%, so we are very happy to see that. Okay, NAV is something like $1.75, right. I don't have to bother about this. I was writing down the price of the REIT when I was looking at this report. I'm not sure if this is valid anymore. Right, so yeah, aggregate leverage is 40.5%, right. When questioned about this leverage being slightly on the high side, the CEO said that she believes that Vivocity is actually undervalued in terms of valuation, and she could probably make an argument for Vivocity to be valued at a higher level, right, and that would naturally increase the denominator to calculate gearing, which would decrease their gearing, right. She also mentioned that actually they have enough financial flexibility and liquidity to meet their debt obligations in the near future, as we will see later. Right, the other thing we'll talk about is portfolio occupancy is at 96.1%. Right, so that's high lah, that's a good thing, right? Right, so we'll just talk about the 4th quarter against 4th quarter results, right, from this financial year to the last. Right, gross revenue, net property income, DPU all increased, right, despite the forex and interest rate headwinds, right. Singapore performance is the main contributor to this good performance, and Festival Walk has stabilized, right. All these performance is in spite of the fact that SGD has strengthened against Japanese yen and renminbi, right. We remind ourselves that when they collect in these currencies and convert to SGD, right, there will be a drop in the amount of SGD as compared to previously, right, because of stronger SGD, right. And DPU we have talked about this. Okay, so yeah, I initially thought they had done quite well in utility expenses, right. The expenses dropped by almost 10%, right, but actually in the end this went to higher staff costs and property management fees lah. So in the end the operating expenses remain more or less flat, right, but maybe we should be glad that this didn't go up lah. Okay, so yeah, nothing much to say here, right, except that we're happy DPU is at 1.8%. We look at the properties contribution. You can see that Singapore, which is the bottom 3 colors, right, MBC, Vivocity and other SG properties are the ones that actually contribute to the most of the increase, right. So just these 3 properties alone contributed $9 million more, right, in this quarter as opposed to the last one. And if we look at Japan and China, they are the underperformers, right. Actually we are quite happy to see that Festival Walk has finally improved, alright, both in terms of gross revenue and MPI. Okay, so again, year-on-year numbers I won't compare lah, alright. You can see year-on-year the DPU drop is 7.3%, right. I believe the last quarter's drop was something like 9%, the DPU in Q3, right. So that's what contributes to the overall underperformance year-on-year, right. All these things we've been talking about it the whole year, so again I won't go into the point, right. So you can see that 30% of their gross revenue and MPI come from China and Hong Kong, right. Later on I'll talk about why I've tried to circle out that number, right. We'll look at the valuation of the Singapore properties, right. It's up 2.7%, right. They compared this with the other properties that they have outside of Singapore, and you can see that I think all the properties outside of Singapore actually lost money. Alright, so this is the change, alright, so this column is the change, right, and they lost this amount of money. Alright, and if we add the Singapore's gain, right, the overall loss is something like that in terms of valuation. Alright, however, they say that if we strip out the foreign exchange impact, right, actually there is a positive effect lah, because some things like Korea, right, it looks like their valuation actually went up, right. So you can see that actually this is higher than this, alright, but because when you convert back to SGD is stronger, right, then it looks like the Korean property devalued in terms of SGD. Okay, likewise with Festival Walk, right, there's actually a very marginal increase in valuation, alright, but because of SGD strength against Hong Kong dollar, it looks like the Festival Walk devalued in SGD terms as well. Okay, so in reality, in SGD terms, there's really a devaluation lah. But they're saying that if we didn't bother about forex, this would be the gain. Alright, so moving on to balance sheet, I don't really think too much about this. Yeah, there's a slight decrease, $1.75. I was thinking about if I were to throw away 30% of their NAV, alright, because 30% comes from China and Hong Kong, right? How much will I be left with, alright? And that would be $1.22 or 23 cents. Alright, so to me, this would be a decent value to buy the REIT because you'll be mostly buying Singapore, right? You'll be like buying 60% Singapore properties, and then the other 10% is Japan and Korea. Right, Korea seems to be very high demand, although it's very small. Japan looks like it's on a slight decline, but Singapore seems to be always performing well. Alright, so I think that if at $1.22 or 23 cents is probably a decently good buy, given that the Singapore properties are very strong, right? So you're buying Singapore, Japan, and Korea, then you're getting the China properties for free. So I value the China properties at zero, which clearly isn't the case, right? I'm sure they can sell it for some money. Right, anyway, moving on. I'm not going to talk too much about the debt, right? It's down slightly, okay? Average leverage is down slightly as well. Adjusted interest coverage ratio is also down slightly, right? This one includes their perpetual securities, so 2.29 times. It's fallen below the 3, alright? But still some way away from 2.5, right? Fixed debt is down slightly. Weighted average cost of debt is up slightly, right? But nothing too surprising. So their available liquidity is very high, right? So it should be able to cover the $1 billion they need to refinance soon, right? Because they got 1.5 billion. Okay. Yeah, fixed rate debts kept above 70% to shield against interest rate uncertainties. Okay, not going to cover that. It's pretty standard from all the REITs. Right, so I think these numbers we also talked about. Festival barely moved, alright, and we'll see later that actually management I think claimed that they worked very hard on Festival Walk, and the numbers actually barely budge, which suggests to me that the macro environment in Festival Walk is just very bad. Alright, so Vivocity, decent shopper traffic. I hope tenant sales will be higher, but anyway, cannot complain about Vivocity. They're getting like double-digit rental improvements, right? So the only thing to worry about is the China properties, right? They say Japan may drop to 93.8%. Later on we'll see why in terms of occupancy, and yeah, the Korean property is high demand. Okay, so yeah, here we have the full year results. Alright, so they say that the China properties, I think there are two. The Beijing one they say is improving. Shanghai one is challenging because I think there's too much supply there. Right, and here we want to talk a bit about Festival Walk and why we think this is a turnabout, possible turnabout position. Okay, in my opinion, the CEO said that previously, right, their rental revision was minus 20%. Last year it became minus 12%, and this year is minus 8.7%. Right, so you can see that the trend of the negative rental revisions is dropping, and the reason why these rental revisions are all negative is because pre-COVID, right, the leases were all at a very high rental rate, right? So when they were at a very high rental rate pre-COVID, there was a lot of demand, right? After COVID, and I think after the protests as well, right, I think demand dropped a lot, and because of the high price before COVID, all the rental revision just is downwards. Okay, however, the good thing is that there's only 6 to 8% left of the pre-COVID leases that have not been renegotiated. That means to say only 6 to 8% left of the pre-COVID leases that are actually at a high base and likely to be renegotiated to a lower rental rate. So the rental revision should be stabilizing in the near future, and the CEO never say when it's going to be positive, but she seems hopeful in the near future. Maybe in this FY, this financial year, is possible. That's my understanding, alright. But she never gave any promises, right? Because yeah, there's only 6 to 8% left of the expensive rentals to refinance. Okay, so the rest should be after COVID has started, which means that we may be able to look forward to positive rental revisions. Right, I think management did say they put in a lot of effort to do events to draw crowds at Festival Walk, and it appears to me that this property is a bit high maintenance and actually frankly from my perspective I hope that somehow they can divest this property away, because if they need to spend so much effort to draw in crowds and there's barely any like improvements in sales and shopper traffic, right, that means to say that it's hard to it doesn't have a natural mode this property in my opinion, right, unlike for example Vivocity or MBC, right, which the management did say that they will never sell these two assets because they feel like they are core assets, right, which I think is the right thing to do Okay, so not going to talk too much about all these things. Yeah, so they'll just shopper traffic a little bit on Vivocity, right. I realized that in the third quarter, which I believe this is the Christmas quarter. Yeah, I was thinking how come it dropped, but I realized that maybe it's because people went overseas. Alright, so that's just a suspicion of mine. I don't really know the real reason. Alright, so we'll go on to Festival Walk. You can see a bit up down okay, shopper traffic first quarter is up, second quarter is down, third quarter is up, fourth quarter is down, right. Likewise with the sales is up down down. Yeah, so quite messy at Festival Walk. Alright, yeah, so you can see that they tried to do a lot of events like this anime gala premiere of the anime and stuff. Yeah, so yeah, you can see a lot of movie premiere stars, right. So they seem to have done a lot of work at Festival Walk to draw in the crowds. Alright, so to me, hopefully they can divest Festival Walk at a decent price so that the REIT can be revalued better because I believe the other properties are pretty good. Right, so anyway, for Japan, they said that they have some occupancy challenges and market softness, right? So this lease is going to be expired, alright, and also this one, alright. So that's the reason why earlier we said that the lease in Japan, the occupancy in Japan could drop to 93.7%, right? It's because of this person who I believe is vacating the premise, alright. Alright, so so this contributes to 6% of the GRI. Yeah, so they are going to try to release this property out to someone else, right? So they say that these two core assets will never be sold, right, as long as as much as what management has said Okay, so the 14% rental revision for Vivocity I think is unlikely to be sustained moving forward It's really good rental revisions, right? And let's see where was Vivocity? 14%. I cannot remember where I saw Vivocity's double digit rental revision, but Vivocity is really high rental revision. Okay, I think it's here. No, it's not. Okay, never mind. I'm sure it'll pop up somehow later. Right, so I don't think I'll talk too much about this. So anyway, the CEO said things that this valuation could be higher, right, if she wanted to argue for it. Alright, the China side, I think Beijing is about 2/3 of the portfolio, and luckily this one is doing well. They said that the BMW anchor tenant has already committed to, I believe it's a long lease. Alright, so they were talking a lot about BMW anchor tenant and how happy they are that they have committed to the lease, right? I think the problem is with Shanghai, which is I think about 1/3 of the portfolio, right? The occupancy is low 80%, right? Beijing, I believe they say it's above 90%, and it represents 2/3 of their China valuation, right? So Tokyo, they said, Japan, they said that is some of the properties are doing okay, some of the properties are on a slow downtrend. Alright, so not too great as well So Singapore is really holding up the REIT, but hopefully moving forward, if Festival Walk is able to stabilize and start to become a positive rental revision, I believe there should be a re-rating for this REIT, because at this point the price is more or less discounted the China and Hong Kong properties right? So if Hong Kong starts to recover, they may re-rate the Hong Kong properties into the valuation in terms of NAV, and the price may go up. Okay, however, please note that none of this is investment advice, right? Please do your own due diligence. All right, so with that, thank you and goodbye.